I'm Scott McGregor at Scott Trades on Twitter. It's This Week in Bitcoin on the Hot Wallet Podcast. First off, I want to apologize for the delay in updates. My family and I were on vacation in Hawaii, and we came back, had two great interviews on the Hot Wallet Podcast, and then the market just got so crazy, I didn't really have time to do any of these updates. So apologize, but here we go. The biggest news has been the price action in markets. In a recent interview with Darius Dale, he warned about the lack of liquidity in equity markets and just generally in risk assets.
If you have the ability to raise cash, go raise cash. Go allow yourself to sleep at night. Well, I'll quote a stat. When we turned bullish in the fall of 2020, bombastically bullish at that point. I don't think I've ever been as bullish prior to 2017 was like the only time I'd been more bullish in my career personally, which was saying, hey, look, there are 5 things that are about to happen, at least according to our models at the time. This is October 2020, that are about to happen that almost never happen at the same time. Growth's going to be accelerating. Inflation is going to be accelerating. Corporate profit growth is going to be accelerating. Margins will be expansion and all that good stuff in that bucket. But then you're also going to have aggressive monetary easing and aggressive fiscal easing. There have been 10 quarters prior to that moment since 1960 that where all those things have happened at the same time. And obviously, you imagine, the annualized returns of things like the S&P are extremely high. And I'm like, hey, we're about to get like 3 of these quarters back to back to back to back. Fast forward to today, we're effectively on the precipice of seeing the exact same dynamic, but in reverse. Growth will be decelerating. Inflation's likely peaking. So by the time we get in the third quarter this year, we'll have inflation decelerating. We'll have corporate profit growth and margins compressing. We'll have aggressive monetary tightening, aggressive fiscal tightening. It's literally the exact opposite scenario that created bubble price charts for every risk asset known to man. And so the expectation that we're going to somehow survive the opposite of creating bubble price charts for every risk asset known to man is it's a fallacy, in my opinion.
Now, macroeconomics were not the only reason for the lackluster price action in risk assets. We had some dramatic news and movement because of a token called Terra Luna. Now, at one point, Terra Luna was in the top rankings in crypto market cap, and the price was well over $100 per coin. The protocol was developing an algorithmic stablecoin. Now, unfortunately, like many other algorithmic stablecoins before it, it failed. And it failed with a depegging of their stablecoin UST. Now, the idea is that you would mint $1 of UST and burn $1 of Luna. That would bring the price up of Luna, and that would also maintain the peg of UST. Now, the problem is, if one breaks, it all comes crashing down. And unfortunately, that's what happened. The token ended up going into a death spiral and is currently trading under a penny. And so it went from well over $100 to under a penny. Now, most of us in crypto land expect that the failure of Terra Luna will force lawmakers to bring clarity to stablecoin regulation. I will say I do know some people who got really hurt in this Terra Luna crash. I read some heartbreaking stories of people who lost it all. Millions of dollars. Some people lost their entire life savings. So it's very hard to look past the human aspect of this. But ultimately, this kind of stuff has to happen for crypto to work. Ash Bennington from Real Vision described a lot of these crypto assets as test tube science experiments. And sometimes, even the well-known ones blow up. And unfortunately, that's what happened here with Terra Luna. Now, I'd like to take this time to just really remind you about the risk of investing in any sort of speculative asset, whether that's a stock, crypto, Bitcoin, or whatever. You need to always have a plan in place for your investment. And if the fundamentals of your trade change, it's up to you to take action and do something about it. As I always try and remind people, never invest more money than you're willing to lose. Now, despite the price action and the lackluster movement of risk assets in the last couple of months, there have been some positive fundamental developments in the crypto space. The Financial Accounting Standards Board said on Wednesday it would consider fair value accounting for Bitcoin and Ethereum. As it stands right now, if any company is holding a digital asset on their account, they have to account for it at the lowest price that the asset trades at, even if the asset goes up. So if I'm a company and I own Bitcoin and I bought it at, say, 40,000 and it goes down to 30,000, but then trades up to 45,000, I have to account for that Bitcoin at the lowest price that it trades. And so the current rules don't really make sense. And I believe that this accounting rule has stopped many companies and businesses from taking on Bitcoin or other digital assets onto their balance sheet. So a change in these rules could definitely open the floodgates and bring more businesses like PayPal, Square, Tesla, and MicroStrategy into the Bitcoin ecosystem. And finally, Grayscale. Managers of the Grayscale Bitcoin Trust have started an email campaign to lobby the S.E.C. to get GBTC to become a fully fledged spot Bitcoin ETF. Now, to date, the S.E.C. has only permitted futures-based ETFs while rejecting physical-backed or spot Bitcoin ETFs. You can read more and sign the petition if you're eligible at Grayscale's website, grayscale.com. That's all I got for you this week in Bitcoin. Be sure and check out our latest interviews on the Hot Wallet podcast at www.hotwallet.ca. I'm Scott McGregor, at Scott Trades on Twitter. If you like this, please give it a thumbs up, leave a review, and I'll see you next time.